You're listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
Hello, and a warm welcome to the latest PMI-based podcast from S&P Global Market Intelligence. I'm Paul Smith, an economist in the team that produces PMI data for over 40 countries around the globe, and I'm delighted to be joined today by two colleagues for what is, after a short hiatus, our first PMI podcast of 2024. So, firstly, let me introduce our regular contributor to these podcasts, Andrew Harker. Hello to you, Andrew. Hope all is well, and hopefully you've got some great content lined up for us today.
Hi, Paul. Good to be back. Yeah, as you say, we've had a bit of a winter break, haven't we? But it's good to get the podcast recording season back underway. Today, I'm quite keen to talk about what's been happening in the Red Sea and some of the impacts on the global economy from that disruption that people probably will have seen in the news. And I've also got some good news coming out of Greece, so looking forward to sharing that with you as well.
Yep, sounds very topical as always. And secondly, we've got another fellow economist from our PMI team, Eleanor Dennison. A warm welcome to you, Ellie, and similarly, hope all is well. And you've also got some great topics lined up for us today.
Hi, Paul. Yeah, indeed. This is my first appearance on the podcast, so thank you for the warm welcome. It's great to be joining you both today, and we've definitely got some interesting topics to discuss, particularly our new Romania manufacturing PMI.
Fantastic. So I think we'll cover Romania towards the end of our 20 minutes or so. But first, let's kick off with you, Ellie. And I think you're going to give us a bit of an overview and some recent developments on a sector of the European economy that perhaps sometimes goes a little bit under the radar of PMI data watchers. That's our European construction surveys. And more specifically, you're going to kick off by giving us a little bit of a look at the Italian construction sector.
Yeah, so I'm the author responsible for writing the reports for Italy, which are in partnership with Hamburg Commercial Bank. We actually produce 3 reports each month: manufacturing, services, and perhaps less well known, we also report on the construction sector. Something I have particularly found interesting is the performance of this sector over the past 6 months or so. The construction sector has really shown resilience in recent months. During the tail end of 2023, when the Italian services and manufacturing sectors were both in negative territory, the building sector was in fact reporting growth. Construction activity has been rising for 5 successive months now, and output peaked in December last year, and at this time, growth was strong. But in recent months, this trend has tailed off, and output has moderated towards the all-important 50 no change mark.
So it's been a pretty positive picture from what I can gather there, albeit you said growth kind of peaked at a pretty decent rate at the end of the year, but has tailed off subsequently. Any reasons for that?
Yeah, so one of the reasons for strength across the sector towards the end of 2023 was the government's super bonus scheme. And just to briefly explain, this was a 110% eco bonus tax credit provided by the government for the purpose of making home improvements, for example, to increase energy efficiency. And towards the end of last year, our anecdotal evidence showed that firms often linked the increase in output to the imminent closure of the 110% super bonus, with firms often racing to complete these orders. After this peak in activity in December, as I previously mentioned, growth continued, but then at a notably lesser pace.
So still a positive picture, of course, in Italy. And I'm interested to know how Italy's comparing to other economies in the eurozone in terms of their construction sectors, such as Germany and France, for instance.
If we're looking at 2 of Italy's main trading partners, like you say, Germany and France, the story differs hugely. Our PMI data highlights that construction activity in Germany has been falling in each month for the best part of 2 years now, where in the past year the rates of decline have been steep. Meanwhile, in the French construction sector, it has also been in contraction territory, though at a slightly less aggressive pace compared to Germany. As well, the overall sentiment among Italian constructors has been positive, but that's not the case in Germany and France. Perhaps this is due to the size of the EU's National Recovery and Resilience Package for Italy.
We can really say, can't we, that the differences seem to be very much linked to public and, I guess, government policies with that super bonus scheme that's, as you say, is now closed. So some really interesting dynamics there, I think, between different performing construction sectors and how Italy's, I guess, bucking a wider European trend at the moment. Another area that is, I think, bucking, shall we say, the eurozone trend is in manufacturing in Greece, which I think, from my understanding, is performing better than the eurozone average at the moment on the manufacturing side. Andrew, just going to come to you on this. Can you tell us a little bit more of what's going on in Greek manufacturing at the moment?
Yeah, absolutely. That's right. It is booking the trend because if you think about it, people might be aware that we've seen our data on eurozone manufacturing, which has been showing the sector struggling quite a bit recently and in contraction mode. But the opposite has been true for Greece, actually. It's been in growth. And if you look at the latest data, which we got for February, we actually saw the PMI at a 2-year high. We saw sharp and accelerated growth of output, new orders, exports are rising, firms taking on extra staff. And they're also quite bullish about the future as well, which is in some parts linked to the prospects for investment. And that investment is actually borne out as well by our Business Outlook survey, where the latest results showed that Greek firms were among the most confident worldwide in terms of their approaches to investment in things like capital expenditure and research and development over the coming year.
Quite a bright spot of, as you say, a fairly subdued eurozone manufacturing economy at the moment, but something that I would have thought maybe would have had an impact on Greek manufacturing, given its kind of geographical position and obviously lots of close ties to shipping and sea trade, would be the recent disruption in the Red Sea. Have you seen any impacts from recent events on the Greek manufacturing sector?
It's good to mention that sort of geographic proximity to the Suez Canal in particular, Paul. I think you're right there. And you also added to that, Greece controls the largest merchant shipping fleet in the world. And so I think those things combined mean that it's quite a useful place to look for if you're looking to try and see what any impacts of the disruption in the Red Sea have been. And there have been impacts. We can see suppliers' delivery times lengthening quite sharply, so a lot of delays in terms of firms getting hold of inputs, and that's making it harder for them to replenish their stocks, which are being used up, despite them actually ramping up their purchasing activity and trying to get more stuff in. We also see an impact on prices. So if you think about it, the extra shipping costs required to move goods over that larger distance geographically is going to add to your shipping costs, and so that's feeding through to higher input prices as well. So yeah, there definitely has been an impact, but fortunately not enough to derail the period of growth up until now.
I appreciated that fact that you pulled out there. I think it was an attempt to resurrect an old feature of these podcasts, wasn't it? And fact of the month, which I think you used to enjoy. So thank you for that. It's definitely worth a little bit of time unpacking that Red Sea impact on the supply side of the global economy. Obviously, we've seen a little bit of an impact there in Greece, aren't we? And I think supply chain resilience remains such a key topic for many people at the moment, especially in that post-pandemic world that we're living in now, and in the context of current geopolitics and various tensions around the globe. Maybe we could just come back to first principles there. How we measure those impacts, Andrew. How do we do it through our PMI data sets?
So the best way of looking at it is to use the suppliers delivery times index, which we have on all of our manufacturing surveys and whole economy ones as well. And with this index, what we're asking the companies to say is whether the amount of time it's taken for them to receive their goods that they've purchased from suppliers has quickened or lengthened, or in fact just stayed the same from the previous month. Just in terms of the interpretation, if we get a reading of the index above 50, that means that we're seeing shorter suppliers delivery times than the previous month. Conversely, if the index is below 50, then that means that lead times are lengthening and delays are getting worse.
That 50 really is the midpoint. Like you say, that indicates no change in a particular variable. I guess what's interesting then is we've got that number now, that 50 number. What's the latest results you're seeing on that index, say at the global manufacturing level?
Our global manufacturing PMI, which is in association with JP Morgan, we calculate that by amalgamating all of our national manufacturing surveys together and weighting them together to get that overall global figure. But if I take you back to January, actually, we saw the index actually drop below the 50 mark for the first time in a year. So that showed actually the first lengthening of lead times for a year. But then what we saw into February actually was that index moved back up to pretty much in line with 50, so signalling a bit more of a stable picture. So I think in contrast to what we saw in that post-pandemic era where we saw things start to lengthen and then sort of a domino effect where it just got worse and worse, maybe we're seeing a bit of an impact in January and then more of a stabilization in February, and that's sort of borne out by the comment tracker data as well. So this is information that we get from the companies we survey based on like anecdotal evidence that they put in, and we can track that over time as well. So reports of shipping delays in January are around 2.5 times the normal amounts, and that stayed pretty stable into February as well. So again, it's pointing to that sense that maybe things are stabilizing a bit.
Yeah, we've kind of seen a little bit of an impact, but as you say, things have stabilized. This is not like we saw 2 or 3 years ago during the pandemic. For context, some numbers were in the 30s, were extremely low readings when we had so much disruption from the pandemic. I guess what's interesting though is that obviously we said there's been some challenges in Greece, but at the global level, is it really quite a muted impact? So how are you reconciling that? Is it localized issues rather than a global problem? That's the reading that I'm getting from that.
So this is where having the PMI in so many different countries is really valuable, actually. You can really drill down and see where the pinch points are geographically. So if you look at, say, Asia, for example, we've not really seen any particular impact there from the trouble in the Red Sea. Over in North America, we saw, again, similar to the global level, a bit of impact in January, but then that eased off again into February. In Europe, bit of a mixed picture, really. So even in Europe, where you'd probably expect most of the impact to be. So we've obviously mentioned Greece, also the UK and Spain quite badly affected in the data there. But then other parts of the continent, for example, Germany, Austria, the Netherlands, still seeing their supplies delivery time shorten. So even within Europe, there's quite a mixed picture geographically, depending on where countries are.
I can bring you back into the conversation, Ellie. What are you seeing in terms of prices? Andrew said there was some impact maybe in Greece, but are we seeing a similar developments at a wider regional level there in terms of prices? We usually associate changes in supplies delivery times to then future changes in prices. So just wondered what you're seeing from that angle.
Across the eurozone, there's definitely been some impact on cost pressures faced by manufacturers, but this has been somewhat muted given the general demand conditions of the sector. When we look at the panel comments tracker data that Andrew mentioned earlier, we've seen a rise in the number of mentions that link increased operating expenses to higher shipping fees. In February, our data indicated there were over 4 times as many comments in that month blaming cost inflation on higher shipping prices compared to the average trend, and this was the highest for 13 months. If we consider the trend for other inputs, for example, raw materials, our data shows that less firms are specifically blaming input price inflation on rising raw material prices than in previous months. And this perhaps sheds some light on the demand conditions of the manufacturing sector across Europe, which have been subdued for some time now. So overall, I'd say that the impact on prices is there, but if demand was strong, perhaps the impact would be larger.
That demand element, that's a key thing as well. It's obviously nothing like the pandemic in terms of global shipping. It's fairly localized-ish in terms of the Red Sea impact. And then, like you say, global manufacturing remains in a fairly subdued position at the moment, in contrast, of course, to what happened during the pandemic. So I think, just to bring this section to some kind of close, it's been a muted impact at best at the moment, and it's really quite relatively localized. It's felt predominantly in, I think Andrew said, Spain, Greece, UK, really kind of European sea trading nations. So I think those are the ones who seem to have felt the most impact so far. So I think, like we said at the top of the podcast, we'd look a little bit towards a new PMI survey that we've just recently launched. It's really is following hot on the heels of the newly minted Canada Services PMI that we launched at the end of last year, which was our first launch since 2019. So like I said, we're going to discuss another one here, Romania Manufacturing PMI. And that's something that you've been really closely involved with, isn't it, Ellie? Maybe you could tell us a little bit more about the survey. And I'm presuming the structure and approach is very similar to what I'd call a classic PMI. We've been doing PMI surveys in Europe at least for the quarter of a century in many countries around Europe. So over to you. You give us a little bit of an overview of how the PMI is set up in Romania.
Yeah, it's definitely really exciting that we've now launched a manufacturing PMI in Romania with our sponsor, the Commercial Bank of Romania. So the methodology, as you say here, follows the existing manufacturing reports that we already provide. And this is where companies are surveyed on a monthly basis and they're asked whether they've experienced any change on the month. For example, is the level of your output at your unit in terms of volumes higher, the same, lower than 1 month ago? For this, we cover a wide range of indices, including output, orders, some prices data, and some inventory data. The panel in Romania is made up of about 400 manufacturing firms, and then this is stratified by detailed sector and company workforce size based on their contributions to GDP. We started collecting the data for Romania back in July last year, so we've currently built up 8 months of back data, and even in the early months of the survey, data has been shown to track official data, for example, our output PMI with industrial production.
Obviously a short data history, but everything else is very much the same as all our other surveys across Europe and across the world, of course. And I think that's one of the key advantages, of course, of the PMIs is that comparability between nations, one of the few statistics that you can directly compare with each other. But what are the reasons do you think it's important that we've launched this survey with BCR?
Romania is actually the second largest consumer market in Central and Eastern Europe, making it a very important economy. This therefore fills a data gap in this region and is aimed at supporting a range of stakeholders, including policymakers, central banks, investors, and corporates. As with our other PMI releases, the data we provide is reliable and timely, given that it's released on a monthly basis and is often available months ahead of the official statistics. Given that the methodology is consistent, like you said before, we can then compare this with other manufacturing PMIs, which is a great tool. It's also a really important economy to its main trading partners, for example, Germany, Italy, and France, mainly exporting motor vehicle inputs, parts and accessories, inputs related to agriculture, iron and steel, for example. So all these inputs are definitely crucial for other European economies.
That's great. Really plugging a data gap, I would say. As ever, we always want to know what the latest numbers are showing as well, don't we? So if you could give us a summary of, I guess it was the February data, wasn't it, really? That would be great.
Absolutely. So to give you a quick roundup, the overall results in Romania have largely been in line with that seen across Europe in general, where demand is really muted. The headline PMI has remained below the all-important 50 no change mark since data collection began back in July, and this indicates to us that manufacturers are facing challenging operating conditions. The largest component of the PMI, new orders, fell at a strong pace in the most recent survey period in February, and this shed some light into demand for Romanian manufactured goods. As a result, firms' input requirements dropped, so purchasing activity at factories has been downscaled in each month for the whole of the back history, the 8 months. And on the employment front, after a marginal workforce expansion in the opening month of July, firms have been in retrenchment, so making cuts in each month since. Finally, cost pressures have remained elevated and manufacturers have raised output charges in 4 of the past 8 months.
Very similar position to elsewhere across Europe at the moment, a relatively subdued manufacturing picture, it would seem. So thank you for that, Ellie. And as ever, I think we've packed a lot into the latest episode. But just for those listeners who may be interested in learning a little bit more about supply chains outside of the world of PMIs, then it's definitely worth checking out some work that we've been doing on the wider S&P Global Group at the moment. We've got an inaugural issue of Look Forward Supply Chain 2024 that's recently been released. What that does, it taps into the knowledge of various specialists around the firm. They're looking at areas like labour, geopolitics, shipping, trade, ultimately to provide a series of articles that go beyond headlines, if you like, and provide a really good critical analysis into global supply chains. And secondly, for people who are interested in a more comprehensive view of supply chain intelligence, then I would really recommend taking a look at our supply chain console, which we launched last year. And what that does is it takes proprietary data and forecasts across trade, pricing, country risk, economics, all together help identify some critical factors to help users really understand and build more resilience into their supply chain planning. So for both that report and the supply chain console, I would just recommend heading over to our website, searching up supply chain intelligence, or look forward supply chain 2024, and you should be able to get some more information on those. So all that's left to say, I think, is thanks again to you, Andrew, and to you, Ellie, for your insights today. And we look forward to seeing you all again later in the year for our next podcast.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and Twitter, and don't forget to subscribe to the podcast so you never miss an episode.